If you've ever shopped for a mortgage, you're familiar with the idea of debt-to-income ratio. Many programs have very rigid guidelines, and you might have heard that your housing-to-income ratio can be 28% of your income. Maybe someone told you it can be 43% of your income. Well, if you're a veteran, I've got really good news for you. There is no maximum debt-to-income ratio, and that gives you a lot of flexibility. Why is there no debt-to-income ratio? It's because the VA uses a much better measure of ability to repay. We're going to go through that measure today, explain to you what it is, why they use it, how it's measured, and most importantly, how to maximize this factor to get you approved for the right home for you and your family that you may not otherwise have been qualified for. If you're enjoying the content and you want to learn everything you need to know to buy wise, borrow smart, and build wealth, make sure to like and subscribe. That way you'll get notified every time we post a new video. We try to post once a week and get you all the information you need to know to become an educated homebuyer. It's important to remember that for all loans, even VA loans, debt to income plays an important role. That role is telling the underwriter, are you likely to be able to make this payment, pay your other bills, and have enough to live off of? So what do we do with most loan types when we're trying to qualify you for the loan? We determine qualifying eligible gross income. So your gross income, the income before your taxes and withholdings are taken out. And we work with that number, and your house payment has to stay at a percentage of that number. So let's review a couple of quick programs that you may have heard of, conventional and FHA, to give us a baseline before we transition to how the VA looks at this. Historical guidelines before we had automated underwriting were anywhere from 25 to 36% of your income could go to your housing payment. Currently, under conventional guidelines, if we're doing a manual underwrite, meaning it cannot go through an automated underwriting system, the maximum debt to income ratio can only be 45%, and that requires compensating factors. If you have an automated underwriting approval, you can go to 45%, most likely with no compensating factors. And if you have a really strong file where you have more equity in your home or a really high credit score, there's a good chance you may even be able to go all the way to a 50% debt to income ratio. Now, let's compare that to FHA. FHA, the maximum again that you can do is up to a 50% debt to income ratio on a manual underwrite, but that requires some pretty significant compensating factors. With an automated approval, you can go to 46.99 on the housing to income ratio. And once we factor in all of your other debts, you can go to 56.99%. So all the way up to 57%. That can be fairly aggressive. Let's take a look at what the VA guidelines say about debt to income and how underwriters are supposed to use it. First of all, it says explicitly that debt to income is a guide. It should not automatically trigger acceptance or rejection of your loan application. The important part is an underwriter is required to consider the ratio in conjunction with all of the other credit factors. The guideline actually says that a debt to income ratio greater than 41% requires greater scrutiny unless residual income exceeds the requirement by more than 20%. So if you have 120% or more of the VA's required residual income, your loan is likely to be approved if you are with a lender who is following VA guidelines directly and doesn't have a bunch of overlays. You may be asking yourself, what are overlays? Overlays are additional guidelines above and beyond those set by the VA that are placed on the loan by lenders. Who knows why they do this? Maybe they feel it's safer. Maybe they feel it makes the loans worth more in the secondary market. But it's important to know the biggest VA lender in the country has significant overlays in terms of your debt to income ratio. I was watching another video from someone the other day at a large major lender, and they said they have no overlays unless your credit score is under 600. So they then start to limit your debt to income ratio. From this perspective, it is important who you're working with, both that they know what the guidelines are, that they understand residual income, and they have options in terms of investors to place the loan with that do not put these overlays above and beyond what the VA requires. So now let's go back and talk about that really important factor that we led off the video with, which is residual income. You may have never heard of residual income. You may not know what it is, and it can be a foreign concept because among major mortgage types, only VA loans use residual income. Let's start with the definition. Residual income is the net income you have left each month after all primary expenses are covered, including your mortgage payments. It's important to remember here that this is net income. This is the money that you have after all of your withholdings, the actual direct deposit into your bank account from your payroll, then less all of your expenses. And we're going to go through a calculation so that you can see this in a little bit better detail. So how much residual income are you required to have? Well, it varies by region, it varies by your family size, and it can vary by your loan amount. Let's take a look at exactly what those numbers look like. So you can see this is broken up into 4 regions: the Northeast, the Midwest, the South, and the West. And then family size of 1 to 5 members. Once you get over 5 members, we need an additional $80 a month of residual income per family member. So just taking a look here, if you are in Florida and you have 3 members of your family, so you're in the South, 3 family members, we're looking at $889 a month of residual income that you are required to have. Now, let's talk about how this is calculated so you can get a little bit more clear on what your loan officer is looking at and what they need to be running to ensure that this will work for you. So now that you know what residual income is and how much you need to have, let's take a look at exactly how your lender is going to calculate your residual income. First, we're going to start with your gross income. Once we have your gross income, we're going to take away the total proposed housing payment, principal and interest, taxes, insurance, if there's an association, anything that you're going to pay monthly with that house. Then we're also going to take away all of your monthly debts. By all monthly debts, what do we mean? Auto payments, credit cards, installment loans, if you have a student loan, if you have a personal loan, childcare expenses. You may have heard that on a VA loan, you will complete a form that says how much you're paying for childcare, or that you either have no children or no childcare expenses. And the reason for that, where we don't have it with any other loan, is that it has to be included in this residual income calculation. We're also going to take a maintenance and utility factor, simple calculation, where we take the square footage of the home times 14 cents, and that tells us what the monthly maintenance and utility factor is. You'll see in an example here in a minute. If you had a 2,000 square foot home times 14 cents, $280 a month is what the VA figures you're going to spend on maintenance and utilities for your home every month. Now, we also have to account for, since we're going to residual income, residual left over after you've paid everything, we have to account for your withholdings on your paycheck. So how much were your federal withholdings? If you're in a state with a state income tax, what were your state withholdings? How much was held back for Social Security? Any other deductions? So we're going to look at your paycheck. We're going to figure out monthly what those amount to and deduct that as well. And that now gives us the actual residual income. So with that, let's take a quick look at an example of a client I'm working with right now in Oregon. All right, as we said, they're looking to buy in Oregon, 2-member family. We don't have any children at this time, and looking to buy a $350,000 home with 0 down and funding fee exempt. So that gives us our loan amount. His gross monthly income is a little over $5,200 a month. When we look down to the payment, we have a principal and interest payment of $2,098, property taxes of about $291, and we're estimating $100 or so for the property taxes. What else do we need to deduct? We have to look at their household expenses. So these guys have a car payment of about $325. We don't have any credit cards, which is good. And we have an installment loan of about $119. Now, they've told me most likely looking at a home in the 1,500 square foot range, but if they found a fixer, something a little further out of town, could be as big as 2,000. So 2,000 square feet at 14 cents a square foot gives us $280 a month for the maintenance and utility factor. So the last thing we have to deduct here to get to our residual income is the withholdings from his pay, so we can talk about net spendable income. So pretty simple there. He's looking at $232 a month in federal income tax, $166 in Oregon state income tax. We got $181 in Social Security, and another $43 in miscellaneous deductions. So the awesome news there is we're looking at $1,414 of residual income, which is about 170% of the required $823 for a 2-person family in the West region. So the good news is we have exceeded the residual income requirement by more than 20%, which means that our debt to income ratio, even though that in this instance is a little bit over 50%, can be totally acceptable to a VA underwriter. In this specific example, it's actually really good to know that that client has a 53% debt to income ratio. With an FHA loan, that would possibly be okay. With a conventional loan, we're never getting a 50% debt to income approved. And in this instance, the VA will have no problem approving that loan because we've gone through and done this residual income calculation that shows for a 2-person family in Oregon with a 1,500 square foot house, we will definitely have enough money left over for them to put food on the table, put clothes on their backs, pay for whatever entertainment. So that's the number that the VA is looking at. It is very important to remember that the VA is not wanting to put you into a position to fail. They're trying to put you in a position to succeed. And what they have found is that this is one of the best measures to determine your ability to repay, whether you're going to be able to successfully become a homeowner and make that monthly payment year after year after year. Now, it's probably important that we look at the flip side. For this family, what if they had too many monthly expenses and we didn't have the $823 a month required? Well, if it's way short, that can be a hard stop because the VA is looking at that as clear evidence that you would not have enough money to get by day to day after the factors that go into the residual income calculation are accounted for, which are pretty much all of your major monthly expenses. So are there any solutions? If you're a little short, we could possibly pay off some debt. Maybe if you had an auto loan for a car that had some equity in it, you could sell the car. We could look for cheaper homeowners insurance, but really we're going to have some limitations there. You could look at a smaller home, which would have a smaller maintenance and utility factor. So a few things, but this one is fairly much set in stone, almost like that maximum debt to income ratio on an FHA or a conventional loan. So if we go back and look at that note in the guidelines that says if someone has 20% or more of the required residual income, they should be considered to have the ability to repay. How does that work out in the real world? It gives us a ton of flexibility in helping veterans and their families get into homes. One of the best examples I can use here is a client of ours named George. George came to us about 5 years ago. He was tired of renting. He knew he had his VA benefit, so he didn't have to put any money down. He had a service-related disability, so he was going to get some benefits there. But when we ran through everything, his debt-to-income ratio was almost 70%. And he said, well, I'm already paying that much in rent, so I shouldn't have any problem. So I asked him, I said, George, how is it that when your current rent is close to 70% of your gross income that you're able to make the payment? He says, oh, no problem. I've got a girlfriend. We've lived together for 10 years. She makes as much money as I do, and we split the bills. So he really had a 35% debt to income ratio. But since the VA only allows a veteran to co-borrow with a spouse, we couldn't use her income. So I always like to tell people, it is not a good idea in most situations for someone to go out and go to a 70% debt to income ratio, despite the fact that they may meet this residual income requirement. What I find is when I have veteran clients that are going to a very high debt to income ratio, utilizing this residual income calculation, it is because there's undisclosed income or income that we can't qualify with. So what do I mean by that? Oftentimes, they're self-employed. I have a lot of veteran borrowers who've gone into contracting and they own their own framing business. And with that, it gives them a lot of flexibility to take deductions. So we look at their total company income and they have a ton of income, but after all the expenses, it's a little bit low. So we have this very high debt to income ratio. We have situations where we have a girlfriend or a fiance, a significant other of any type who lives in the home and helps pay the expenses, and we can't use that for qualifying purposes. Even situations where someone's caring for an elderly parent. That parent has income, and we know that income is coming in is going to offset the payment. So don't think of this in terms of sort of carte blanche to go to a massively high debt to income ratio. That is not what the VA is saying. They're saying we're going to give you flexibility to determine what is right for you. A lot of times I have borrowers coming to me and they say, hey Josh, I just need to know what I can afford. And I tell them, hey, that is not my job or my role. What I can do is tell you what you can qualify for. So once we figure out which loan programs you're eligible, within those guidelines, I can tell you what is the maximum you're able to borrow. We then have to put that into a framework of what you feel you can reasonably afford. The thing that I like to point out is two otherwise identical borrowers in terms of income, debts, what shows up on paper, even money in the bank, they could behave very differently out in the real world. If one family eats dinner out every night and is looking at taking a vacation every 3 months over to Hawaii, they're going to have far less available to pay their monthly expenses and should go to a much lower debt to income ratio than another family with the exact same household income and the exact same debts that show on the credit report, but that cooks at home every night. And they take a vacation to grandma's house once every summer and they drive and they stay there cost-free for a week. So very important for you to know that this is a tool that allows you to make the best decisions for you in your life. The VA is trying to put you in a position to succeed. They never want to foreclose on a home. They never want to have a loss on a home. They never want to have a borrower go through that headache and heartache. So this is not something that is simply here to allow you to buy more home than you can afford. It's allowed to give us the flexibility to make sure that veterans can make the best decisions for themselves and their families. And the most important thing here is over time, this has proven good for taxpayers and good for veterans. Other than conventional loans, VA loans have the lowest default rates, which they're very close to conventional loans, despite the fact that a VA loan does not require a down payment, doesn't have a minimum credit score, and as we've been discussing here, doesn't have a maximum debt to income ratio. So they are underwriting these files. They are looking closely at them to help you succeed. So what does this mean for you? It means it is critical that you get with a lender, a loan officer like myself, that knows the VA guidelines inside inside and out. Automated underwriting systems will often spit out an approval for a VA loan, despite the fact that the loan officer has no idea what the residual income calculation is and has not done it and has not input it into the system correctly. A lot of times when I'm doing a cross qualification for my realtors, I'll take a look at the automated underwriting findings, and you look in there and you go, there is no way that is an accurate residual income, because the loan officer didn't input that information. So garbage in, garbage out. We have an approval that might be valid, but a very good chance that it's not. So for you, it is essential to get with someone experienced with VA loans that knows the residual income calculations, that knows the requirements, and knows how to use that in conjunction with the automated underwriting system to get you the best terms available. It's also important that that loan officer not work for a direct lender or a bank who places overlays on these guidelines. Some of the worst things that I hear from big online lenders, the biggest VA lender in the country, is that they don't tell borrowers, you don't qualify under our guidelines. They say, you don't meet the VA guidelines. And when we talk to them and say, let me look at it, we dig a little deeper and we say, we have absolutely no problem here. Now, the reality is, of the 40 or 50 investors I can sell a VA loan to, many of them do have overlays, but a lot of them don't. And we have all of the flexibility to not only find you the best terms, but also the best underwriting guidelines. So if you're a veteran who's been told that your debt to income ratio is too high, that you don't qualify, and you're hitting roadblocks and you just want a second opinion, or you want to start out on the right track, use the link below to connect with us. We'd love to hear more about your situation and see how we can help get you great terms and the best loan for you and your needs. Thanks for watching. Have a great day.